Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we dive deeper into strategies and tips to help beginners invest wisely and grow their money over time. Active investing is the opposite of passive. Here, fund managers or individual investors try to beat the market by actively buying and selling investments. They believe they can pick winning stocks or time the market to achieve higher returns than a simple index fund. This approach requires a lot of effort. Active investors spend significant time on research. They analyze company financial statements, industry trends, and economic forecasts. They make frequent trading decisions trying to capitalize on short-term market movements. This means buying when they expect a stock to rise and selling when they think it might fall. While the idea of beating the market sounds appealing, it's very difficult to do consistently. Many studies show that most active managers do not outperform the market over the long term, especially after accounting for higher fees and trading costs. For beginners, active investing is generally not recommended. It demands a deep understanding of market dynamics, a lot of time commitment, and the discipline to handle potential losses. It can also be very stressful. You might end up making emotional decisions, which often leads to poor investment outcomes. Stick with passive strategies when you are just starting out. Common investment vehicles for beginners. Now that you understand the why and how to prepare for investing, let's look at the what. Many different investment options are out there, but as a beginner, focusing on a few core types makes the process much less overwhelming. These are the building blocks you'll use to start creating your diversified portfolio. Stocks. Ownership in public companies. When you buy a stock, you are essentially buying a small piece of a public company. This means you become a part owner or an equity owner of that business. If the company does well, growing its profits and value, the price of your stock typically goes up. As an owner, you might also receive regular payments called dividends, though not all companies pay them. For stability, many beginners look at blue-chip stocks. These are shares in large, well-established companies with a long history of reliable earnings. Think of businesses that have been around for decades and are household names. While no stock is without risk, blue-chip stocks often offer more predictable performance compared to newer, smaller companies. Bonds. Lending to governments and corporations. Unlike stocks, bonds aren't about ownership, they're about lending. When you buy a bond, you are lending money to a government or a corporation. In return, they promise to pay you back your original loan amount, the principal, on a specific date, and they also pay you regular interest payments along the way. Bonds are often seen as a more conservative investment compared to stocks. They can add stability to your portfolio and provide a steady stream of income. Because they are typically less volatile than stocks, bonds can help balance out the risk in your overall investments, particularly during periods of market uncertainty. Mutual funds and exchange-traded funds, ETFs, diversification made easy. Trying to pick individual stocks and bonds can be complicated, especially when you are just starting. This is where mutual funds and exchange-traded funds, ETFs, come in. Both are types of investment funds that pool money from many investors to buy a wide variety of stocks, bonds, or other assets. This gives you instant diversification, meaning your money is spread across many different investments. If one investment performs poorly, it won't drastically impact your overall portfolio because you own so many others. For beginners, low-cost index ETFs are often a top recommendation. These ETFs track a specific market index, like the S&P 500. When you invest in an S&P 500 index ETF, you effectively own a tiny portion of 500 large U.S. companies. They offer broad market exposure, diversification, and very low fees, making them an excellent choice for a simple, long-term investment strategy. Robo-advisors. Automated investing solutions. If the idea of choosing investments still feels overwhelming, a robo-advisor could be your solution. Robo-advisors are online platforms that use algorithms to automatically manage your investments. You typically answer a few questions about your financial goals and risk tolerance. The robo-advisor then builds and manages a diversified portfolio for you, often using low-cost ETFs. They also automatically rebalance your portfolio, which means they adjust your investments periodically to keep them aligned with your target allocation. Robo-advisors offer a hands-off approach to investing with very low fees compared to traditional financial advisors. They make investing accessible and straightforward for anyone new to the process, putting professional-grade portfolio management within reach. Getting started. Practical steps for your first investment. Ready to move from learning to doing? This section guides you through the practical steps to make your very first investment. It's simpler than you might think when you break it down. We'll help you pick the right accounts, understand how they work, and start investing even with small amounts. Choosing the right brokerage account. First, you need a place to hold your investments. This place is called a brokerage account. Think of it as a special bank account for stocks, bonds, and funds. Picking the right one is important. Consider these factors when you choose a brokerage. Fees. Look for low trading fees or no commissions on trades. Many brokers now offer commission-free trading specifically for stocks and ETFs. Platform ease of use. Is the website or app easy to navigate? As a beginner, you want a platform that makes buying and selling straightforward, not confusing. Test out demo accounts if they are available. Available investment options. Does the broker offer the types of investments you want? Most major brokers offer stocks, ETFs, mutual funds, and bonds. If you have specific interests, double-check they are available. Customer support. When you have questions, good customer service is helpful. Look for brokers with responsive support channels by phone, chat, or email. Some popular options for beginners include Fidelity, Charles Schwab, and Vanguard. Online-only brokers like Robinhood and M1 Finance also have user-friendly interfaces, but always review their fees and options. Understanding basic investment accounts, taxable versus retirement. When you open a brokerage account, you will typically choose between a taxable account or a tax-advantaged retirement account. Understanding the difference is key for your long-term financial health. Taxable brokerage accounts. These are flexible. You can put in as much money as you want, and you can withdraw it whenever you need it. However, you pay taxes on any gains you make in the year you realize them. Tax-advantaged retirement accounts. These accounts offer special tax benefits, but they come with rules. 401k. Often offered through your employer. Money goes in pre-tax, reducing your current income taxes. It grows tax-deferred until retirement. Some employers even offer a matching contribution, which is like free money. IRA, individual retirement arrangement. You can open an IRA on your own. Traditional IRA. Contributions might be tax-deductible, and your money grows tax-deferred. You pay taxes when you withdraw in retirement. Roth IRA. Contributions are made with after-tax money. Your money then grows tax-free, and qualified withdrawals in retirement are also tax-free. Roth IRAs are popular because they offer tax-free income in retirement. For beginners, consider both. If your employer offers a 401k match, contribute enough to get that free money first. Then, look into a Roth IRA for its tax-free growth potential. Starting small. Dollar cost averaging. You don't need a large sum of money to start investing. One of the best strategies for beginners is dollar cost averaging, DCA. This simple approach helps you invest consistently and reduce risk. Here is how dollar cost averaging works. You invest a fixed amount of money regularly. You stick to this schedule, regardless of whether the market goes up or down. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares. Over time, this averages out your purchase price. It removes the stress of trying to time the market, which means trying to predict the best moment to buy. DCA helps you avoid investing a large lump sum right before a market dip. It builds disciplined investing habits and lets you grow your wealth steadily over time. Many robo-advisors and brokerage platforms allow you to set up automatic, recurring investments, making dollar cost averaging very easy to implement. Don't let the idea of investing intimidate you. Open a brokerage account, set up automated contributions, and choose a simple, diversified approach like low-cost index ETFs. Your future self will thank you for taking these first steps towards building lasting wealth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.